there's one like fifth-time private equity owner. And when you layer them all together, you're like, oh, this is how like private equity works. And each one has their own nuance. So I was like, it's just repackaging it in a different way.
Who do you think is going to buy the book? People that work in private equity now?
KKR.
Or people that want to understand it better?
Yeah. It's the audience of the podcast. I mean, it's like the 2 books I did are 10, 12,000 copies. It's like the podcast
That's
audience
niche.
who wants the book.
Any RIA private equity people? No.
Oh, yeah.
It's all institutional stuff.
Yeah.
No.
You mean
Like people
Any
buying.
Yeah, you know how many
Like-
RIAs get
like-
bought.
investing in
Yeah.
Oh, it's
Or
huge.
Oh,
like-
yeah.
Yeah.
So what about that? We're not good enough here?
For an audience, you mean?
No, for
No,
the
for a
podcast.
chapter.
Yeah, for a chapter.
Or for the podcast?
Well, I hadn't thought about that.
Like
it's
a
Mariner, it's a really good
or
idea.
like
Private
a
equity-
Carson
Yeah, it's
or
the
like
biggest one.
these
Doing
guys.
deals of
Do
I'll
Edelman
do it. I'll do it with you
Financial
guys.
Engines,
No,
or-
I'll do it with you guys.
No, we never took any private equity money.
Yeah, but you're buying RIAs, right?
No, never.
No.
No.
What
I
about
mean,
like
I
a
could do it with
Carson?
Rockefeller. Like that'd be
Well, yeah,
good.
Carson.
Carson, you could
Mariner.
have Jamie Hopkins is great.
Yeah.
Yeah.
Yeah, do it with Carson. They have private equity
Yeah, I
sponsor.
haven't yeah.
Right.
Could easily do that, right?
See?
Just
you're
haven't thought
already,
about it. That's huge.
you're already getting something
It's a
out of
roll
this.
up. There you go.
All right, good. All right, you sound good. Are your headphones up
I'm
to
good. I'm
speed?
good. I'm good.
Yes?
Yeah.
All right. Are you still futzing with the camera lens? I
I was
you're-
just focusing.
I know you're a perfectionist, but let's get the show on the road.
So,
yeah.
let's do
Good. All right,
market
let's
is
get the show
ripping
on the
again
road.
today?
3
Wow.
coming in.
All right.
We're going.
All right, you guys excited for this?
Yeah.
What are you sending texts right now?
So
We're about to start
the
show.
market's
Put
ripping.
the
I want to see
phone
what's going
away.
on.
Don't mo-
Today's show is brought to you by Crane Shares. Check out our Talk Your Book episode that's on Monday on the Animal Spirits feed with Crane Shares. We're talking about CLIP. I call it KLIP. That's their China internet and covered call strategy. That was a very interesting conversation. Thank you to Crane Shares for sponsoring today's episode. For more information on CLIP with a K, visit craneshares, also with a K.com/KLIP.
Don't multitask me. What episode is this? episode 97, ladies and gentlemen. Welcome to The Compound and Friends, everyone's favorite podcast about investing, finance, business. What else do we do on the show? We do
Romance.
romance. We are going to have an amazing show today. Thank you guys so much for listening and joining us. We have 2 very special first-time guests here at The Compound and Friends. And I'd like to introduce them in no particular order, but Ted, you're going to have to wait.
That's fine.
All right. Shana Sissel is here. Shana is the founder, president, and chief executive officer of Batnick Capital Management. Wait, did I do that right?
You did.
Okay. Do people get that one wrong too?
All the time.
Okay. Is that an Irish word?
It is. It's Gaelic. It means queen.
Wow.
I know, right?
Well, that makes sense.
Just totally makes sense.
All right. Batnick Capital Management, where she helps advisors with alternative investing, platform development, and portfolio construction. Shana is a constant contributor on both CNBC and Fox Business. That's not going to last long. One of them is going to make you exclusive, where she offers her insights on the current state of the markets. Shana, can I start with one question?
Sure.
How did you become the queen of alts?
Okay, so Cynthia Murphy
Did the
from
last queen get their head cut off? And
I don't
then
know.
It was you?
Is
I don't
Howard
know.
Stern
I have no
self-proclaimed?
idea,
Is it
but-
self-proclaimed or somebody gave it to
By
you?
the
Somebody
way,
gave it to me.
Okay.
The queen of alts, ladies and gentlemen.
The Queen of Alts Media.
John is clapping. Let's show some deference. All right, how did you get this nickname?
So Cynthia Murphy from Tidal
Yeah.
gave me the nickname. I was on their show, their happy hour show,
Yeah.
like a year ago, right after I started Bonrian, and they asked me where the name came from, and I told them Bonrian means queen in Gaelic. My mom's Irish from Ireland, and so I was looking for something cool that sounded cool.
Yeah.
And Queen Capital Management sounded incredibly lame, but was also taken. So I just threw the word into a translator, and then that came out, and I thought, that sounds cool.
Home run.
And so she was like, oh, that makes sense that you're the queen of alternatives. And then that's how it came to be.
Now, do you have any official duties as queen? Are there things that you have to? Are there things that you have to do in that role, or?
I do not have any official duties other than running my company, which is the Queen Company. So
Okay, but you are like 24/7 alts.
I am.
Okay, so
Yes.
so even if you just like randomly got the nickname, I feel like you're going to grow into it, and
Yeah.
you will be the acknowledged
Yeah.
queen of
So
alts.
Cynthia's my Paul Pierce.
Okay.
So
Yeah,
the Shaq to my Paul Pierce.
I'm the king of all balds.
There you go.
Michael's the king of all balds. All right, and we have the king of alts. No, I'm just kidding. And we have Ted Seides is in the house. Ted is the founder of Capital Allocators, where he is the host of the Capital Allocators podcast. Ted launched the podcast in 2017, which has since reached 16 million downloads. That's a big, for people that don't know, that's a big number. Across all platforms, Ted has also written 2 books. So You Want to Start a Hedge Fund and Capital Allocators, both of which have generated high reviews. He will publish a third, which we were just talking about, private equity deals next year. Ted, welcome to the show.
Thanks, guys.
So happy to have you.
Fun to be here.
Your podcast is awesome. I know you know that I feel that way. Was I on it a million years ago?
You're the only episode of the 300 or 400 thus far marked explicit.
Attaboy. All right. Very proud of myself. Thank you. All right. So what is it? What is give us like the format of the podcast for those that haven't discovered you yet? How many times a week are you putting out material?
Yeah, 1 or 2.
Okay.
Interview show. I interview. It's all in the institutional investing world.
Mm-hmm.
So the money managers and the client side.
Okay. Very cool. And you love it.
It's awesome.
Yeah.
It's kind of the same thing I've done for 20 years when I was investing before doing the
Yeah,
podcast.
but now the mic is on.
But now the mic is
No, but you've become like much more public. You come from the hedge fund world where nobody says anything.
Yeah, that's right.
So that's a very big difference.
Yeah.
But you have a lot of hedge fund people on the show, and they want to talk. The thing is, I don't think they want to talk to just anyone. They want to talk to somebody that can actually be on the level, and I think that's what you come to the table with, and it's really unique, and people love it. You gonna keep going?
That's the plan.
Okay. All right. Very cool. Welcome to the show. We're going to start with where I think we kind of have to start. I'm going to play something.
Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
All right. That was the line that people didn't seem to love, I think, or one of the lines. But we had an FOMC meeting this week. The Fed did not raise rates. That was the expectation, right? Mm-hmm. Okay. There was an instant sell-off in the market, which then repaired itself a few seconds later. Not that big of a deal. I wanted to hear from you guys what your thoughts were, if we learned anything new this week, and if markets are kind of like just over the whole idea of whatever the Fed's going to do or not do next.
I totally thought this was a posturing thing.
Okay.
In that it's kind of like the parents telling the kids, like, you behave, or it's, or this is going to happen. I really felt like it was their way of saying, look, we're going to pause, but if you guys don't get out of hand, because if you
buy
do,
NFTs, if you
we're
buy
going to
NFTs
break.
again.
Right, we're going to break everything. That's how I felt it. What surprised me the most
Wait, the
was
Fed said, put that NVIDIA down,
well,
or I'm coming in there.
I still own some, so
Okay, all right.
Yeah, so that's kind of how I viewed it. And the thing that surprised me the most was that there were so many people on the committee that are predicting 2 more rate hikes. Like, I thought 2 was possible if the employment markets didn't break.
Right.
But I thought that was low probability. But like the vast majority of the people on the committee were like, 2 hikes are coming before the end of the year.
Well, don't ask me. I thought they were done 3 hikes ago. So I don't.
Shana, you just said something interesting about them breaking something. I think the expectation from the market was they're going to go until they break something. Well, guess what? Yeah, I guess you could say that regional banks broke, but the thing that they wanted to break specifically, I think, is the labor market.
Yes.
And they didn't break it. They paused.
Yes. Because nobody wants to be the guy who is like trying to get people
Fired.
laid off.
Which
Right.
was
Say it.
that was the
Yeah.
narrative a couple months ago. They want people to get fired. The Fed wants you to lose your job. Well, they paused.
Yeah.
But the market is still expecting another 25 basis points in July. Mm-hmm. So it's not done. If Infinity goes to 2 trillion, they're going to it up again. But for now, they're pausing.
Ted, how do you see it?
The Fed, when they speak and talk about 2 projections, I think of it as a meditation. They're only talking about what they see in the moment right now. Mm-hmm. So a month from now, that could change if the conditions change. So the markets don't think that way. The markets are predicting in what they said at this moment in time.
Right.
But that's not really how their process works. But you had unprecedented QE going in 15 years ago. You've got this unprecedented, intractable problem of you got the banking issues on one side and you got to tame what's going on in the economy on the other side. I have no idea how they navigate through this, but I don't really watch each month after month because I just don't think it matters.
Also, unprecedented contraction in money supply,
4% in the last 9 months in M2, a little over 4%.
which I think has happened once.
Yeah, but we also had like an unprecedented rise.
True.
So, of course. But that's actually where I think the opportunity is in the market right now is you have to think about if we're going to be pulling liquidity from the system. Maybe they don't do it with rates, but maybe, before the financial crisis, like QE wasn't a thing. But now they can do things where like headline rates stay up and they can say they're being tough on that, but then they can do stuff on the balance sheet.
Right. They could stop letting as much mature and go.
Exactly.
Or I want to share this from Peter Bookvar, friend of the show, as to what the Fed statement said yesterday and confirmed by Jay Powell in his presser. I'll just repeat my belief again that at this point, keeping rates at current levels for a while is more relevant than whether they hike again or not, which I don't believe they will, as it is a continuous form of monetary tightening every single day for someone, business and household, whose loan is coming due and isn't being paid off and replaced. I'll also add that QT, quantitative tightening, becomes more of a focus with the rate hiking period taking a breather. That's interesting. So now it's almost like, all right, one more rate hike or no more is not really the thing. It's how much longer are we staying tight and how committed are they to continue to shrink the balance sheet that's going to have a bigger impact. Peter talks about mortgage holders and how they're doing in the current market. And I think one of the big issues is you've kind of turned the housing market upside down in Peter's framework. Nobody wants to sell.
Right.
And so here, highlighting how locked in mortgage holders are with the spike in rates and how upside down the Fed has turned the housing market. Redfin updated its stats of where today's homeowners fall on the mortgage rate spectrum. How many homeowners would you guess have a mortgage rate locked in below 3%?
60.
I was going to say more like 75%.
23.5%.
That's it.
Really?
Below 4%?
Oh, then it's much higher.
62.
All right.
Well,
That's
because
the sweet spot.
with 3, you have to nail the bottom, pretty much.
Right.
Below 5%, 82.4% have a rate below 5. That's down from 85.7 1 year ago. And then below 6%, that's 91.8%. So 91.8% of U.S. mortgaged homeowners are below 6. The record was 92.9% a year ago.
Well, they broke the housing market. The existing housing market has been frozen for
They froze
a year.
it.
Yeah.
I don't know that they broke
No, they
it.
did. They broke. Well, what's the difference?
Well, the difference is existing home sales.
Are broken.
But no, the difference is prices.
They didn't. Yeah, prices have not budged.
So
no,
that- like,
and they're
that's
not
what I
going to
would
budge
think.
because there's
Yeah.
no.
They're
like,
not going to. It's supply demand.
Where I am in northern Chicago burbs, like Wilmette is one of the suburbs that I like border. The median home price in Wilmette is like $900,000,
And not dropping.
these are not big, huge houses. These are 2,500 square foot, 3-bedroom, 2-bath kind of things.
Same with us.
And they are not dropping. And the thing that I find most interesting is that they're on the market for like a day. I think the average time on market's like 20 days at most. And there's houses I'll see like coming soon, and then they never come on the market because they sold as a pocket listing before they ever went on the market.
Don't you think this is part of the irony? The Fed can't build houses.
Nope.
So scarcity is keeping prices high, and high shelter costs are a big source of the inflation the Fed is trying to fight.
We're not gonna show this on the show, but this is mine and Josh's neighborhood. 825. Now this won't sell. This won't sell for 825, but it's probably a 2,200 square foot house. Like it's a fine house, but this should legitimately sell for
because there aren't 50 of those on the market.
There's like 3.
Right.
The other part of the dynamic is coming out of COVID, particularly in suburbia, like where we are, the inventory got gutted by people moving out from the city. So anytime you're in suburbs around the city, inventory got shot, and then you had the rate hikes. So now no one's going to move.
So if you're the Fed, you know you can't build houses yourself, but you kind of need there to be less housing scarcity. You need more houses. But if you raise the rates, at which builders borrow, you're not going to get them. So, to me, it's almost like I understand why you have to raise rates to fight inflation. You're just not going to be able to fight housing inflation that way.
If you want to turn into what you do about it, right? There are, in the alt space, this booming market of single-family rentals.
Yep.
The Queen has already informed me of this.
I actually rent a single family home for that very reason.
Yeah.
And the reason why is because during COVID, we were looking, buying or renting. And even in the rental market, people were saying, I'll give you 6 months rent. And there were like bidding wars to rent houses.
Crazy.
It was crazy because it's a good school district and people wanted their kids to be in person. And the scarcity
Oh,
of
the renter was saying, I'll pay you 6 months in advance.
6 months in advance. And there was like bidding wars.
Bidding wars to rent. Unbelievable.
So this is the thing that maybe interest rates maybe you need interest rates at 15%.
No, it's structural. People need
structural.
houses. People my age need houses.
This seems like a problem that the banks can do some financial engineering on. I just feel like
Say
this.
more. But
this is-
how
Well, why
so?
can't you take your mortgage with you?
Well, here's the thing that I think is going to
If you-
happen. You know
right?
how everything has unintended consequences, right? Like,
Yes.
Wall Street loves to create product to solve a problem, but then eventually whatever they
Create a new
created
one. Yeah,
creates
yeah.
a new one. I feel like that's inevitably what's going to happen here, where some like exotic types of mortgages or something to like what you're saying, you take your mortgage with you or you pass a mortgage through to whoever your buyer is, your rate. Something like that's going to happen, and then it's going to blow up.
I think the UK has that, portable mortgages.
Yeah.
Because everyone's stuck. If you want to move, you can't afford to move.
Right.
Unless-
And even the people who like are traditionally like, the empty nesters who want to downgrade, like they're not going to do that. The bigger house costs them less than if they sold it to buy the smaller house.
And they have to go somewhere, and renting is not exactly attractive.
Exactly.
Here's one more thing that rates have done. This is, so I got a new credit card this week, and they said the APR is 28% on an Amex, 28%. The average interest rate for all credit card accounts from 94 to today, look at that. If you are falling behind on your credit cards, you are so screwed.
28%. How
That's
does
crazy.
anyone pay that off after a year? Think about what that compounds to.
Yeah, ludicrous.
All right, I want to pivot, and Ted, I want to tell the story. And I know you've told the story a lot, but it is the 15-year anniversary of the bet. Is that
Yeah.
do I have that right?
Yeah, that's right.
Okay, so 2007. I'm not even gonna tell the story. Well, I'm going to ask you questions, and you're going to end up telling the story. 2007, you make a bet with Warren Buffett.
Yeah.
And this is the thing that I think you became the most known for, like in terms of the media.
That's the podcast, but before
No, I mean originally.
Sure.
Originally. So you make a bet with Warren Buffett, and the gist of the bet is that what?
the gist of the bet. So the bet started in January 1.
How drunk were you and Warren,
2000.
by the way? Was it like a drunken bar room? No, I'm kidding.
No, wait, what was the genesis? How did this even happen?
Yeah, we don't even know
So
that.
So in summer 2007, I read something that he had said to a group of students. So he had said in one of his annual letters the whole had rocks, got rocks thing about fees, just generally.
Right.
And somewhere along the way, he made some comment that a group of hedge funds could never beat the market. So there was this transcript, and someone had asked him about it. And he said, well, no one took me up on it, so I must have been right.
Oh, he like rhetorically made a bet to himself.
Yeah, exactly.
Okay.
So I read it, and in the summer of 2007. So keep in mind, I was running a hedge fund of funds at the time. We were short subprime mortgages. This is before it all really collapsed. But
Yeah.
hedge funds for a long time had beaten the market,
It was a
And-
good decade for hedge funds up to 2007. Yeah.
and the S&P 500 was trading at historical highs. And so I just read it and said, "Look, he's a very smart guy, but he just made a bad bet." So I wrote him a letter. Like on a computer, but I didn't have his email or something. He doesn't have email. So I just sent it to him, and he responded. It became this back and forth email exchange about what this thing was and what it was going to be.
Wait, you wrote him physically and
In the mail.
And he emailed you back? Or somebody
his
emailed you?
assistant emailed with a little chicken scratch note from him.
Oh, that's hilarious.
And there was a letter exchange, just pure cat and mouse game, sort of. One of my partners said when he read it at the time, he said, it's pretty clear to him that he's the patsy at the poker table, but he has the most chips.
Okay.
So we consummated this bet, which ultimately was 10 years. Call it a group of hedge funds. It was actually 5 hedge fund of funds. There's a whole reason for that. Against the S&P 500.
Isn't that too many hedge funds to start with, though? 5 funds of hedge funds?
Yeah, I was going to say 5 hedge hedge fund of funds? Like, why not just pick like
Yours,
global
for
macro
example.
or something?
So let's go back. Okay,
So
you're in 2000.
We could go to your childhood.
You can
Ted
go-
was
we-
nine-
we
Ted
can
was
do
9
that
years
too.
old.
I'm honestly riveted by this story.
So the
because
question is, what do you think the bet is? So let me ask you that. What do you think you're betting on if you're betting hedge funds against the market in January 1 of 2008?
you're betting on more volatility, I suppose, and having enough hedge funds that are
Dispersion.
capable of making money.
The housing market
dispersion of
blowing up.
returns.
Okay, like I think that's completely wrong, all of that.
I'll just leave.
So if most of the time hedge funds are boring. You could say they're boring and they don't make a lot of money these days, and then they were boring and they made 8 to 10% a year, but they're boring.
Right.
The market's generally not boring. So if the market's trading at all-time highs, and you look at any historical metric, you say, what do you think the projected 10-year returns are going to be? If you thought that was going to be bad, you would bet on anything but the market. If you thought it was going to be good, you're going to bet on the market over anything else. And if you're not
Okay.
sure, it's like, okay, fine, historical averages. So I viewed the bet as a referendum on the S&P
For that particular 10-year
for
period.
that particular
Go
10-year
forward
period.
from 07.
Right.
Okay.
And it sure looked that way.
well, you
in
looked
year
really
one.
right a year later.
Yeah. And
Yeah.
it looked that way for 4 or 5 years.
Right.
You know, Fed comes in the next year and you had 9 years of the S&P up like 18% a year, which is way above historical averages. And sure enough, you know, the S&P won the bet.
Right.
That's it.
Okay. So, but how did it become public that this bet existed?
So we agreed that Carol Loomis would come in and write about it.
Okay.
So she wrote a piece that came out in the middle of
Is that Fortune or?
Fortune. I
Yeah,
think
yeah.
it was the middle of 08. Maybe it was the middle of 09. I don't remember exactly when it came out. One of the great lessons in the media. So Carol writes a really, I was shocked. I was like, how are you going to write an article about this little bet? But she wrote this great piece about how it all came
Little did you
about.
know.
She's amazing.
Yeah.
Well, a good sign of the media, that was the only piece written based on facts. And it was very simple what she wrote. Everybody else wrote about it. 90% of what everybody else wrote was factually incorrect just about what the bet was.
Because they didn't
based on
talk. Because they didn't talk to either of you.
No, because they didn't read her piece.
Okay.
So, it's hedge funds. No, it was actually fund to funds. It was,
Right.
the more they were betting against Warren Buffett. No, it was against the market. All these like little factual inaccuracies, just a little thing about the media. So she reported on it, and then Warren announced the results every year at his annual meeting.
Oh, you must have been thrilled.
That was fun.
Yeah. Okay.
Especially what he used to do was every year right before lunch, he would announce the results. He said, I told you I'm going to announce the results of the bet. As you can see, I'm losing. Let's go have lunch.
Okay.
The first year he got ahead, he wrote 2 pages in his annual letter.
Shout out to Warren. All right. Did you ever get on the phone with him and just like you got closure on the whole thing? So he wins
yeah.
in the official result is what? End of 16 or end of 17?
It started in end of 17.
End of 17. What are the actual results? Just let's clear up like all the misconceptions people have.
Yeah. So I don't remember the exact numbers. The market was up, let's call it 7% a year during those 10 years. As it turned out, and the hedge funds were up like 2 or 3. So the market won by a lot.
Okay, but the hedge funds were still positive returns.
Yeah.
Okay. Was there a lot of turnover in the 5 funds of funds that you selected, which means that the thing that you were betting on originally had changed, whereas the S&P really didn't change much other than some stocks getting smaller or larger? Was that like a big factor?
So I would say 2 things. Part of the reason you do fund to funds is so that you don't have that turnover, right?
Okay.
You don't have a fund that goes out of business. So the
A
funds,
single fund, right.
The
Okay.
funds that we picked were the same. I don't know exactly what was going on in them. Obviously, like as Shana said, one of them was ours that we were running. I'll tell you some fund turnover. The largest position in one of the funds.
Berkshire,
Lehman.
No, keep going though.
Bear,
No, Ted Weschler's fund.
Apple.
No,
The guy that ended
Peninsula,
up getting Buffett's.
the guy that Buffett hired.
Yeah.
And so that was the largest position, but then he gave all the money back. So Warren was losing. I guess he became an activist investor because he started pulling out the talent.
Okay, got it. Oh, he pulled Ted out of the fund that was competing with him.
Yeah.
Oh, here's what I wanted to ask you.
Interesting.
How did the other 4 funds of funds feel about being thrown into this very public bet with Warren Buffett? Did you like get their consent beforehand or?
Absolutely. So
Okay.
part of the main reason we never announced who the funds were is number one, it doesn't matter for the theory of the
Oh,
bet.
I didn't even know that.
Yeah,
oh,
it was
so
never
you didn't
announced.
say who the funds were.
No. Warren knows, and we get the audits, and so it was all verifiable.
Warren definitely knows because he started recruiting the people who were beating him.
That's hilarious.
two of the fund-to-funds said they would participate, but they didn't want it to be known, so we just made it anonymous for everybody.
Okay, I think that was the right decision.
But-
People don't want to be in a horse race with the greatest investor of all time if they don't have to.
Yeah.
You wanted to
But
be.
they were in a horse race
didn't.
with the S&P. But be that as it may,
Yeah,
but we JP Morgan does this great guide to alternatives, and the dispersion on hedge fund returns, it's all over the place.
Yeah.
Right? People think of hedge funds as a category, but I know you know better than anyone.
It's all over the place, and there are actually liquid alts like ETFs and mutual funds that do a lot of the same things hedge funds do without leverage, which affects their returns. But there's so much in there. And to your point, my favorite chart in that guide that they do quarterly is basically their version of the Ibbotson chart, because I talk about this all the time, but we teach advisors how to build equity portfolios and fixed income portfolios, but you have to build an alt portfolio, especially with those hedge fund diversifiers, in the same manner, where like you don't pick one, you don't like all bets on global macro,
Right.
all bets on market neutral.
Okay, so you're right. Advisors have no idea.
Yeah, so
right
that
now
chart
how
is
to do that.
fantastic because it points to exactly what you're talking
Yeah, people
about.
talk about hedge funds as if they're one thing, but
Yeah.
there's long only hedge funds, and there's
Yep.
market neutral hedge funds, and there's global. I mean, there's a million.
Yep.
So is that changing? How do you see advisors evolving to incorporate hedge fund like strategies or alts or whatever you want to call them in their client portfolios?
Well, see, now you're just teeing me up to promote
Well,
myself.
no, because
But, yeah.
I don't know a lot about this, frankly.
There's definitely more interest. The 60-40 is dead narrative that we've been hearing. I've always said it's not dead, it's just evolving. Liquid alts have made it possible to invest in hedge fund-like strategies.
Let's
and
define
there's-
that for the audience. When somebody hears the word liquid alts,
Okay.
what are they hearing?
So two different definitions. When I say it, I mean like ETF mutual funds and interval funds that any investor can buy. Some people mean it as invest in liquid underlying.
The first
but when
definition,
I
though, is
refer
the
to
one.
it as
Okay.
ETFs, mutual funds, and
So it's
interval funds.
strategies that don't require all the paperwork.
Right,
You can buy
exactly.
it in a TD
Yeah.
account.
You don't have
Yes.
to have a K1, but you can
Exactly.
have a strategy that's not
That's doing
long only
ETF.
an asset
yeah,
class. Okay.
Exactly. There's some constraints to it because the SEC says if you register under the 40 Act, you have limitations on leverage and things of that nature. But you can include those things in your portfolio and improve risk-adjusted returns. But you have to kind of understand that they are low correlation. Right, so
For better and worse.
For better or worse, they are low correlation. I actually got in a really interesting Twitter debate about
fun.
liquidity,
Well, don't do that.
about a fund in this space where somebody was like, "Well, the 10-year returns are negative." I'm like, "This fund is either up 25% or it's down because of its correlation." But just a small percentage of it and a traditional 60-40 actually substantially improves your Sharpe ratio, substantially. So your ride is no longer a roller coaster and it's a lot smoother.
So the end investor should want to hear that from an advisor because why? Because risk-adjusted returns,
Yeah.
meaning less
Compounded over
discomfort.
time. Compounded over time, it's not sexy. In the JP Morgan Guide to the Markets, they have a chart in there that talks about a 30% allocation to alts, and then it shows how it improves returns and reduces risk. And so they do 30%, and they're using HFR, so they're using private funds. But I have a similar chart in the deck we use that uses liquid alt products, like the model that I run. So my numbers aren't nearly as sexy as JP Morgan, and I'm only suggesting a 20%, not 30%. You got to get advisors at 4 right now. So we got to move them there a little
Is that
by
where
little.
it is? It's
Yeah,
at
it's
4?
about 4%. So I do 20%. So it's not sexy. Over 10 years, it's 15 to 20 basis points and improvement in annualized return. But think about that on a compounded basis. And then also think about the fact that your standard deviation of a portfolio drops by 100 to 150 basis points. It's even more dramatic if you look at the JP Morgan guide.
As an advisor talking to people from the alts world, the first question that I would ask is, should I try to time
No.
which strategies I choose to use? Should I represent to the client that I feel now is a good time for long short because of elevated market valuations? Or is that not the right thing to say?
I would suggest you would do it, and Ted, correct me if I'm wrong here, because you ran a fund to fund. I worked for a fund to fund. That's how I got into the business. But You wouldn't do that with equities, right? Like if you were building a portfolio,
advisors
you wouldn't.
would. Not
Some
all.
would, but
Yeah, we would not.
you would kind of say like, I have large growth and I have large value, and maybe I tweak it at the edges, like I'm slightly overweight value, but you're never not in growth. And I would suggest that in the alts world, you kind of have to think of it the same way. Now, I do sometimes add something into the portfolio that I would not hold over the long term, but there's a foundation that like never changes, might tweak around the edges.
Okay.
And that's kind of how I focus on it. You build it the same way you'd build equity or fixed income. It's just nobody talks about that.
Do you see it the same way?
I do. The return drivers in a hedge fund strategy are much fuzzier than, say, like if you own a stock, it's beta, it's small cap, large cap. So you think about long, short, there's a component that's interest rates. And then most of the rest is the spread of the long performance versus the short performance for an individual.
That's manager skill.
Yeah. It's manager skill.
Right.
So it's really hard to time. Like within the different hedge fund strategies, the one place where you do see people come in and out a little more is just based on what's happening in the credit markets.
So would that be macro allocations or credit opportunities?
If
Like
there's a lot of
arbitrage,
distress.
like a muni arb or something like that, or distressed securities.
Yeah, when yield spreads are wider, you might see more credit exposure.
Okay.
And when yield spreads are really narrow, people might dial that back. But it's really hard to predict what strategies will do well.
I have a question about risk-adjusted returns. Like, how much do they matter? Like, if you're looking at your account 4 times a day, yeah, smoothing it would probably be help, although you shouldn't be looking at that often. But if you're looking at a statement twice, 4 times a year, twice a year.
So I might be the only person who's ever come on the show that would profess to have learned something from Josh. Okay.
This is really.
Let me explain
This
this.
is a big moment.
Years ago,
Get the TikTok camera ready.
Years ago, Josh came on the show, and this is in the early years of Ritholtz, and I'm talking to him about, like, do you use alts for your clients? And he kept saying the same thing. Doesn't matter. Doesn't affect them. Doesn't matter for them to get the outcomes they need. So this question of like, well, risk-adjusted return, does it matter? What are you optimizing on? Are you trying to optimize for the result of someone to grow their assets to retirement over some time horizon? You might not need it. If you're trying to be more sophisticated and you say, okay, you already know the core of what you're doing is 70-30, 80-20, and you want it to be as good as it could possibly be, then you do care about risk-adjusted returns, and you have to think about, like as Shana said, how much of that should be
Right, so the 20% is not a catch-all for everyone.
No, but 20% is kind of like somewhere between 20 and 30 is kind of the optimal, where you can get the best risk-adjusted returns. Anything less than 10, it's not going to have much of a difference. Anything more than 30, it could hurt you.
So less than 10, like almost like why bother?
Right.
Okay.
But I will say this, kind of why does it matter? Okay, so if I'm an advisor, my goal, and the reason I'm being hired by clients, right, is to help them reach some goal in the future, right? So if that future time period happens to correspond with a really big market drawdown, like you are not, so having that smoothing is actually good so that you don't potentially have the risk of a drawdown.
If it works.
Yeah. Well, I'd like to say it works. My portfolio does. But the point here.
No. If the managers.
Right. If the managers work.
That you pick do their job.
Yeah. But if you diversify and those kind of things, like that matters. But yeah, there's a risk that you could have a massive drawdown right before whatever that endpoint is.
Sequence of return risks.
Yeah. So you have that problem. And then I always say this all the time. No one is going to get overly excited. Like your client doesn't care if you beat your bogey by 5%, 10%, or whatever. They definitely care if you miss it. You will definitely get fired for missing your bogey, but they, honest to God, if their goal is to be able to pay and live a comfortable retirement with a certain number, like if you meet it, slightly exceed it, really, they don't care.
I think
they just want to meet whatever the goal is.
One of the problems with alts on the end client side is people have a tendency to line item all of their investments. So you could say till you're blue in the face, no, this is part of the whole portfolio. Mm-hmm. But if they see managed futures underperforming for 10 years, they're going to get rid of it, probably at a bad time.
Exactly.
They're going to insist that you get rid of it.
But that's why I started Bonneman, is because we wanted to help advisors be able to have those conversations and be able to talk about those things. And then I talk about this all the time. And this is kind of a nuanced way of doing alts for advisors. It's a little different than the institutional way, is I like to encourage advisors, to build a traditional alts portfolio to be able to scale and have alts be part of the conversation all the time. But when it comes to alternatives, the coolest thing about it is the universe is very broad and you can invest in a lot of things. And so I like to say that advisors should look for ways to build and deepen their client relationships using alts by creating opportunities to connect with your client through an alternative investment solution. So
How does that work?
All right, so if this appeals to me, it probably appealed to you guys. And I listened to one of your shows where you talked about this. Sports rights.
Just one?
Well,
I do like that. That was a good one.
But sports rights, right? Like how excited are you to call a client and say, I have this opportunity in this fund and you're going to own a piece of your favorite sports teams. They don't care it's illiquid. It's not ever going to come up on the line item because it's an ego. Well, but no, we're talking about $50,000 minimums, accredited investor hurdles, things that normally you wouldn't be able to get into.
But that's exciting.
But that's exciting. And that's what I'm talking about. Like there's a real opportunity here to grow and build a relationship with your clients. Like whether it be what I like to call ego investing, or I also say impact investing, where like we were talking to a firm earlier this week who is doing like some, residential real estate in a place where it really needs affordable. And like 25% of everything they build goes to housing for heroes. And so you feel like you're doing something good for your community. Now you're connected with it. And now you're deepening relationship with your client. And they're invested in something that they then now feel emotionally connected to.
So the mathematical returns should not be the entire story of why you're looking at alts.
Exactly.
Even though you want good returns, there are other benefits. I think Scaramucci figured that out like 15 years ago. And look, I've talked to the advisors that used to sell Skybridge, and they're like, dude, don't you understand that if I have a $10 million client and I can give $250,000 of that to Steve Cohen in some way, shape, or form, I can't do that myself. Anthony's platform can do that.
Right.
The client isn't worried about is it up or down more than the S&P. The client just wants a piece of their money managed that way.
Yes.
And that's what I'm doing. And, the Bogleheads forum would explode listening to that shit. But, I understand it as somebody that deals with clients.
Right.
They sometimes do want to hear that there's something interesting happening with their capital.
Well, not only that, but if you think about it, individual investors are emotionally attached to their money. So why not provide them with an opportunity to be emotionally attached to their investments?
Okay. I totally agree with that. I like that as well.
Hedge funds were the stars coming out of the dot-com bust, certainly coming out of the global financial crisis, but it seems like they were replaced with private equity, whether it's venture or more traditional buyout type stuff.
Well, it's beta to equity. So venture...
Without the daily marks.
Yeah, that's all it is. Like I always like to tell people, there's alts that aren't diversifiers, so they don't belong in an alt bucket. So private equity, venture capital, that's equity beta. Like it's a different mousetrap, obviously, because it's not public markets, there's an information edge, and you can get more alpha, but it's still equity. And like same thing with private credit, it's still credit. It should be part of it. It's just an illiquid slice of your traditional equity and traditional fixed income.
So I want to ask you guys about this. There was always this idea that there was an illiquidity premium, which made sense, right? If you can't get liquid, you should pay a lower price, you should have higher returns. I totally intuitively makes sense. However, and I've said this, and Cliff Asness has said this much better, I think there should be almost an illiquidity premium where I would sacrifice returns. Let's just use the S&P. Let's say I can get 8-9% in the S&P. I would take 7.5% if I don't have to have any volatility, even if it's bullshit. Even if I know this volatility, I don't see it, I would pay for that.
But yes, and that gets back to the earlier comment about do risk-adjusted returns matter? You asked if risk-adjusted returns matter.
I would.
So what you're unraveling...
With part of my portfolio, not the whole thing.
But Michael, what you're unraveling is the difference between the underlying investment and the behavior of investors.
Right. Yes.
The beauty of locking it in a box for 10 years is nobody can get in the way.
Well, you want to get your money back? Tough shit.
Hold on. That's why real estate families are rich.
Yeah, because behavioral finance says you always try to get your money out at the worst possible time.
So no one's figured this out yet, but it's possible that the best private equity strategy is taking the S&P 500, leveraging it up, and locking it up for 10 years and seeing what happens.
I saw an interesting proposal where somebody was trying to do this. I know there's a legal structure where there's a pool of money that invests in the S&P, and if you want to take your money out, you have to pay everybody else to get out. And everybody who stays in, it's like
that's
like a tontine.
That's a tontine, but it's somebody has to die. Somebody has to
die. But anyway, my
also.
bigger point is that I think investors would be happy to give up some returns in order to have the illusion of stability.
How about I just change your password?
Come on.
Well, come on. You're talking about a physical lockbox. I'm saying I'll just borrow you.
No,
you
I'm
sign a
not. No, I'm
contract
not.
with me.
I'm saying
and I'll
that's-
bar access to your account for 10 years.
It's not crazy. I mean, if you talk to the people in the institutional market, one of the reasons why people embrace private equity is just that, right? They're reporting to a board. Maybe they're only in their seat for 5 years. So if they think they can make good investments and other people can't get in the way, there is value to that. There shouldn't be. Like to Josh's point, you shouldn't pay for that.
Everybody behave perfectly, which of course they don't.
Right.
Yeah,
Right.
but it's also a lot easier if you're an endowment to not behave that way because it's not your money.
It's 100-year money.
Well,
It's
you would
not
think.
your money.
But it's
You'd
a
think.
career.
You'd
It's
think.
their job is on the
Job
line.
risk is the biggest risk
Yeah.
in institutional investing.
The alternatives represented more than $20 trillion. This is a big queendom you have going. $20 trillion of global AUM as of year-end 2022 and accounted for half of the industry's global revenue.
It's more like 13. The marks are wrong.
Right. And accounted for half of the industry's so half of the asset management business's revenue is coming from alts, generating more than $190 billion for the firms that offer them. So it's a $200 billion a year business with $20 trillion in AUM. So alts are enormous. I think the liquid alt part is the part that's really growing, though.
Yes, interval funds are changing everything. And the original stuff that came out in interval funds.
Can you tell the audience what interval funds are?
So interval funds are like an evolution of closed-end funds. That's the only way I can explain it. It allows for product to be offered that's illiquid by having only like quarterly ability to
Partial
get
liquidity.
a partial
Put money in and
liquidity.
out.
Yeah,
Okay.
and it's partial liquidity at those quarterly. It's not like you can go get everything, but it will say you can take out up to.
But you could also
10%.
put in.
Yeah, you can put in as much as you want. It's just how much can you take out at
Right,
any
right,
given time.
right.
So
Hotel California.
yeah, but the cool thing about it is the original interval funds that came out, I didn't love. I was not a fan because it was
Why?
like long short equity with a lockup that was worse than like a traditional hedge fund that still had an accredited investor hurdle. And I'm like, why am I doing this? Interval funds still have some constraint by the 40 Act. I'm just go to the LP, better liquidity, more options.
Who are the biggest asset managers here? Is it still like Blackstone and those?
Yeah, it's Blackstone. It's
What's
you
the
know,
biggest interval fund? Like for people that want to look it up.
I don't know. I
Or
haven't even
who's the
looked that
bigger
up.
provider in that space?
I don't even know the answer to that question. Like the ones that I've looked at, there's been some stuff that's come out like in the VC space that's like interval. I'm trying to remember the name of the one that I looked at in the long short space that was interesting. But a lot of it is like hedge fund companies, not like traditional asset managers that are coming out with this. But like Blackstone has a lot. Like BREIT was an interval fund.
And B-Cred is big
Yeah,
there.
yeah. So those are examples, and BREITs, and those
Yeah.
are probably the biggest ones now that I think about it. But the more interesting stuff's coming down the road. There's a lot of venture capital firms and a lot of private equity firms that want to launch interval product, which will make those illiquid markets that have never been accessible for like the average investor accessible.
So
to
it
the
gives them
average
access
investor.
to more capital?
Yes.
I can't imagine that not being a hit in the wealth management channel. If like hypothetically, like A16Z or Benchmark or somebody with a great brand
Yes.
and great portfolio companies was just like, all right, here's how your clients can not buy the scraps, the bottom of the barrel, private companies, but the best ones
Yep.
in a way that they don't have to be locked up fully for 7 years. And if they need some of their capital back, we can make it available.
I will tell you personally, I'm not going to name names because it's not appropriate, but we talk to venture capital firms all the time because we're raising capital for the firm. But a lot of them will come to us and ask us if we can help them with their interval fund. There are big names out there right now that are launching interval funds in the VC world that are going to make a huge splash.
I agree. I think it's going to be a big deal
Yep.
because people, A, want what they historically haven't been able to have.
Mm-hmm.
B, it's an important asset class. It's like a maturing but now very, very well understood asset class.
Mm-hmm.
Venture is?
And in the last 5 years, everyone's nephew launched a company.
Right.
And most people's sons and daughters are working for stock options at a startup.
Mm-hmm.
That's just what's going on.
Did you guys see the
So-
chart of SoftBank, the number of deals? Who put this out? This is, John, we throw this up, please?
Pitch book.
Yeah, PitchBook. I guess this is. I'm drawing a blank. Which company is this again? Whose logos? I get their email every night.
Oh, I believe this is FTX. Go on.
Anyway, we're looking at the number of deals and the amount of money deployed. And obviously 2020, 21 was a blow off top. What is that, $60 billion of funding? How many deals? 200 deals. And year to date.
You may never see that again. You think you'll ever see 2021 levels of deal funding?
I don't know. If you go back to 99.
I don't think the dollar amount was the same.
Yeah, but I think we always have these fits and spurts. There's always speculation that happens, and that typically corresponds with.
So it's 200 deals, $60 billion in 1 year for SoftBank.
That's CB Insights, by the way. That's the chart that I was. That's the company I was looking to. Yeah, it's crazy. There was a big article in Bloomberg a couple of years back, like a feature piece on. I'm jumping around in the doc on the Vision Fund. You guys remember this? Masayoshi Son, SoftBank, and the $100 billion blitz on Sand Hill Road. I tweeted this in 2018, and I said I have a feeling this won't age well. The gist was he was trying to raise a new $100 billion fund every year. And that was that. I mean, it went on for a while. That was 2018.
But here's
the party
the
went on for a while.
Here's the problem: $100 billion having to deploy that.
How?
You have to.
Right.
You're going to invest in bad deals.
Right.
It's just too much money. You can't be.
So we saw their pizza company.
Yes,
I forget what it was called.
But he had a 300-year plan. So you can endure a lot of bad deals in 300 years.
Yeah, but then hopefully it's only institutional
There's not
investors.
enough companies to soak up that amount of capital.
Let me read this to you guys, get your reaction. And I understand this is not representative of most venture funds. When SoftBank founder Masayoshi Son launched his $100 billion Vision Fund over half a decade ago. Is that an increment we're now using? Half a decade? 5 years ago, the economy was sunny, startups were being sprayed with money, and a new tech-led era was on the horizon. He claimed to have a 300-year plan. Blah, blah, blah. A lot of shit happened. WeWork, robot pizza, dog walking. On Thursday, this is now, the Japanese conglomerate's technology investment unit reported a seismic $32 billion loss for its full year. I mean, that is a lot of money to lose in a year.
Especially when you don't have to mark to market and you can make up the prices.
Yeah, so it's probably worse.
There's a little more to it than that. If you go back to what he was trying to do, you could mark when Amazon went public, it went public at like a $400 million market cap, and now it's $1 trillion company. There was a thought that there was an arbitrage between the private markets and the public markets, and if you could provide a lot of capital, you could capture it. If you went back 2 years, that Vision Fund was up mark to market, $60 or $70 billion. It's probably more than anyone had ever made in that space.
Because why? Alibaba was a big holding.
Well, they had a lot of things.
They had
worked.
A bunch of things
and that was after WeWork.
Oh, ARM Holdings, I think was successful.
Coupon went public,
right.
Huge valuation. Part of the problem wasn't, I mean, that was a first mover, but then you had Tiger Global doing the same thing. You had Coatue on top of it. That $100 billion became like 150, became like 200.
Right. All the deals got inflated.
And ultimately, it didn't work. But
and they were the ones given the term
rational.
sheets. So they were the conductors of the musical chairs, and everybody was dancing to their sound, and they had to, right? They were doing deals. I think Tiger was using Bain, right, as their consulting to do the due diligence, and then it was just like term sheet.
But they also had this idea that if you overfund the startup that you're investing in, then that startup could dominate a market faster than any competitors could arise.
Brother, this is
that's back to like that Amazon concept.
There were problems with the model. What they were trying to do was capture a beta that the public markets used to capture.
Right.
It wasn't irrational to try to do that.
Right.
And you say like $100 billion, that's crazy, that's too much money. Maybe, but like how much would that have gone public in the IPO markets? Hard to know. Right. Look, it didn't work. Things rolled over. It's been a disaster. But it was kind of an interesting, like this is one of the things that happens in alternatives. You have people who spot some type of opportunity that the public markets, the public credit markets aren't normally going to see in the normal course.
He's mostly gambling with his own money and with Saudi oil money anyway.
Well,
so
also, this is something
nobody's like upset about it.
It also would not happen if interest rates were not at zero for as long as they were. Just period.
Mm-hmm.
Put this VC investment fall sharply. Ted, you put this in the doc. What are we looking at here? This is from PitchBook.
Oh, I don't think I put that.
I
Not
did.
you?
I
Oh, it's
did.
you.
All right,
Unbelievable.
that's a Batnick slide.
So yeah, just what we're looking at is just the number. Again, it's the same thing as SoftBank, just the number of deals and the amount of deals. And 2021 was the blow off top, and deals are dead right now. There's just not
so
a
this
lot of
is
activity.
Q1 2023.
I
that
can
3
personally
deals?
attest to the deals are dead part because it's been a grind trying to raise capital
Okay,
right now.
you're not going to get 0% interest rates back, but the IPO market is starting back up again.
Kava, how do you pronounce
I was down
that? How do you
it's
pronounce
Kava,
it?
and I was down at NYSE, and it was awesome. They were like giving away.
like a real
units and
IPO.
stuff. Yeah, it was a great IPO.
Yeah, so you can do deals again, and now that we got a couple of big ones done, this one, Kenview, all right, don't you need that to come back before you see venture deals?
Yes.
Like it's
Yes.
cause and effect.
Yes,
If there's no exit, then there's no entry.
yes.
Okay, so
absolutely
that's
true.
the good news. The past couple of weeks, I guess, right?
Yeah, in the Kava deal, I think it came in oversubscribed because I think the original price was 22, and I wasn't there when it finally opened. But when I left, it was the spread was 42, 43.
So I'm holding up my computer for the audience, but this is a chart, and it's going up. It looks like a breakout. You know what that is? That ticker is IPO.
Oh, that's actually a fund I really like, the Renaissance IPO fund. I do like that fund a lot.
People are coming back. Can we talk about Goldman for a sec? Ted, did you start your career there?
No.
Okay.
No, I never stepped inside an investment bank.
Okay. So there was a lot of pieces on Goldman this week. One came from Semaphore about they're getting rid of Green Sky, which makes loans through middlemen. Okay, that was a customer acquisition play, I guess, didn't work well. Puck had a hit piece about all the executives jumping ship. And then yesterday, the day before, the Wall Street Journal had like a pretty big one. Goldman Sachs is at war with itself, and this was the lead. Blank Fine, holding court at the hotel bar before a gathering of Goldman partners groused about a successor, according to people familiar with the matter. David Solomon, Blank Fine said, was spending too much time away from his day job, jetting around in Goldman's private planes and DJing at nightclubs and festivals. Blank Fine wasn't the only one complaining. Partners faulted Solomon, who wasn't present at the bar, for presiding over a money-losing expansion into the consumer lending that Goldman is now unwinding. The consumer business, they said, didn't make partners money. That stood in contrast with the bank's other units, cracks are forming in a Wall Street institution, the vaunted Goldman Sachs partnership. So there's 420 partners, and they're talking on the press.
Well, the problem is you're not going to get 2021 back. So 2022, everything was cut in half or worse.
Right.
No matter what you were doing. So
Well,
I never understood why Goldman wanted to go into the consumer. Like, Goldman was the, like, creme de la creme on the institutional side, right? So why... I almost feel like that's like going into the consumer and the retail market to them is kind of like below them.
Yeah, I totally agree.
Like it almost tarnished the brand in some way, which is
They
why
didn't have a choice.
they.
why?
First bank holding company, 2008.
Oh, that's true.
they became a bank to survive 08,
Right.
just like Morgan Stanley
Yeah,
did.
but this is kind of an inevitable thing when your brand was never about that. And to some extent, the prestige factor goes away when anybody, it's
All
no.
right, but so they hired a lot, and they had 50,000 employees now, and they laid off 4,200, and they're probably not done. But it's a lot of mouths to feed out of the same bonus pool, and that's why all these hit pieces are surfacing because people are calling Bill Cohen and saying, "Hey, I don't know if you heard about this," or "Hey, Lloyd Blankfein is sitting at the pool in Miami talking shit about Diesel." You're getting these hit pieces because the profits were cut in half. How much of that is his fault? Of course they're cut in half. What did 2022 have to do with 2021? It was night and day environment for banking, for IPOs, for M&A.
But think about who his peers are and how they come across. Like you have
Morgan
Jamie
Stanley looks
Dimon and
great right now, though.
JP Morgan Chase, like Jamie Dimon, it's like the preeminent king of that space right now, and he's not going around
Michael,
DJing
put
and
up the
stuff.
stock price.
I was saying, what's interesting?
Look at the scoreboard.
Stock price has been okay.
Stock price has been fine.
Goldman Sachs
So-
stock price.
so
But
look-
this is like, if you circle back to what I was talking about with the bet, don't believe everything you read.
Yeah.
So
This
look,
is Morgan-
so this is since Solomon took over. So Morgan's in the lead. Okay, Morgan Stanley's.
Since late 2018.
So October 2018 is when David Solomon started.
Okay.
Morgan Stanley, who is crushing it, is up 90%. Goldman is up 52%, XLF is up 21%. And so that's just as intense, but we're acting like it's so bad. Over the last year, it's not that bad.
Look at it
This
since
is
2021.
this is just internal drama, though.
But
you know
I
what
think
I'm
it's
saying?
about the bonuses. That's it.
Yeah, but the cool thing about this as investors is when people are distracted by a bunch of noise, it can be a good entry point.
But guess what? Yeah, Goldman's actually outperforming Morgan over the last year. That's news to me.
Morgan Stanley went down market.
How about that?
Morgan Stanley went down market, and it worked. They bought E-Trade. It's not the only thing they did. They've made a lot of really good moves. They've added to wealth management in a substantial way.
Eden Vance, Parametric.
Yep.
Right. So they went down, I don't know if it's that far down market. They didn't buy Robinhood. But their stock price is better.
Yeah,
and
but
the perception is also better.
But Morgan Stanley had Dean Witter. I mean, that's where I started my career. I was a retail financial advisor. So that wasn't so far outside of what Morgan Stanley did versus Goldman.
Goldman going to consumers is very odd.
Yes.
It did not work. And if you look at, the stock has done fair. Like in Salman's defense, the stock has done fair. But if you look at their investment banking activity, which was their business, they're getting hosed. Like JP Morgan has taken all of it.
Goldman bought United Capital, which
Yep.
is a retail RIA,
Yes.
gigantic firm built by Joe Duran.
Yes.
Legend.
Who is awesome.
Yes.
I think, is Duran speaking at Future Proof?
I don't know.
All right, Joe, you're invited. Goldman did that deal. I think people on both sides of that deal scratched their heads.
I was working at Orion when that deal happened, and we were working on a deal with.
I think I was in the office with you. I said, holy shit.
Yeah. I was. So the United Capital people were like, wait, do I have a Goldman Sachs email address now? Because these are retail RIAs. They are not Goldman
Right.
people. Not that that's good or bad. I'm pointing it out. They wear khakis to work.
Right.
Okay. If you're lucky. Internal Goldman has wealth management. And they were probably like, what the is this now?
Right.
Wait a minute. I'm sharing clients with no offense, these schlep rocks?
Yep.
I didn't start. So that deal made everyone scratch their head. And I'm not saying it's good or
then they
bad,
went and
but
started about custody.
so that I wanted to ask you about this. So now the new if you talk to Goldman people on the wealth side, the new thing that they're really investing in, and I'm sure they'll do a great job, is building out custody. That is I don't want to call it down market, but that is a nuts and bolts, mechanical, non-Goldman-esque bit. That's like not a type of business that you think a high-flying Goldman Sachs executive would be excited about. So when you put all of these things together, you can understand why all these reporters are getting juicy shit about, quote, turmoil inside Goldman Sachs.
Yeah.
And maybe there is turmoil. We don't know.
No, I mean, there definitely is, because they're talking. A lot of them are not using their names when they talk to the reporters.
So
but
guess what happened today? Apple and Microsoft closed at a new all-time high. XLK was in I don't know if it was quite like a 35% drawdown, and it's just about at an all-time high. What a ride. Unbelievable.
Ted, you want to make another bet?
Wow.
maybe don't bet Apple. All right, where are we going next, Michael?
What is quiet luxury? Please explain this to me. Who put this in the doc?
I put this in the doc because I have questions.
I actually am a bit I'm a non-logo person.
You've been quiet luxury before it was cool.
Yeah, I can't remember what happened, but I had a friend, or I was dating a guy at some point in time, like a decade ago, who was like, "It's so obnoxious when people wear logos," and me wanting to whatever
Ted,
impress. I stopped wearing
sleep
logos,
over my watch.
and to this day, I don't buy anything with logos.
So quiet luxury is like a $200 plain white T-shirt.
Or
New York Knicks shirt?
or a $2,000 handbag, like a Louis Vuitton handbag that doesn't have the LVs.
All right, marked by
prominently.
expensive materials and muted tones, quiet luxury, also known as stealth wealth, is the complete lack of logos and anything too conspicuous, said Thomas Sidari, professor of marketing and director of fashion and luxury program at NYU. Quote, luxury brands rely on the quality of the materials, and they have techniques that are very particular to them.
Fearless.
Such as the cut. This is quiet luxury. This is actually loud non-luxury. Such as the cut, stitching, or other small details only recognizable to those who are very familiar with a particular item. That becomes a differentiator for those in the know. So it's almost like if you don't know that my shit is really fancy shit, then you're not in the club. And a lot of this, I think the trend setting here is from Succession.
I'll take it from here. Shana, do you know what this H stands for?
I don't.
Hermes.
No. Homage. Wait. So this is like the fashion trend of the moment, probably of the summer and maybe longer. I don't know if you know, Ted is wearing a $1,200 Loro Piana ensemble.
There's a massive
This is
like
just proof
weird.
that you can fool anyone some of the time.
You are stealth wealth. You are the epitome of stealth
There is
wealth.
such extremes in here. You have the stealth wealth side, but then all of a sudden you also have Walmart got a new creative fashion director, and like people on Instagram and the influencers going nuts for like Walmart women's fashion is through
Really?
the roof right now.
Yeah, but does
So
it
it's
have
a
logos
stock.
on it?
No.
So
and
then
that's
that's
the
part of
thing.
this.
Right, it is, but it's Walmart and you paid $10 for a dress.
Quiet
I
discount.
love it.
So I'm from Long Island.
We know.
We don't do stealth wealth. If it doesn't say Givenchy, I don't want it. If it's not,
Givenchy, what the hell is that?
all right. There's not enough time on the show. Michael shops on Instagram. I don't want Ferragamo shoes without the logo because I just might as well not wear them at all. So from where I come from, I don't think this is going to catch on. But in Manhattan, maybe in LA,
When I say,
this is what's going
no
on
offense,
right
because
now.
you probably wear these. When I see the giant Ralph Lauren, I just think douche.
Well, how giant?
Like big.
Okay, mine has really big horses.
I saw a big horse at soccer the other day, and I just saw douche.
I have one with a horse so big we have to feed it. So no, not to brag, not to brag. So what are your thoughts? Does this continue, or does this just go in and out of? Should I rip the logos off all my clothes?
Well, you said you're from Long Island and that would
So
never
I shouldn't.
fly, so I'm going to go with no.
No, but I want to improve myself.
I personally think it will go on forever, and I actually think it's a good trend. Because quite frankly, if you're going to spend that kind of money on something, you want it for the quality and you want it to not go out of style. And having logos on everything is something that is going to go out of style, and you're not going to be able to wear when you're like 80, or maybe you will. But
Also, repeat wearings.
right.
So if you have something that's understated and not logoed up, and you don't have a giant Gucci emblem on your chest,
Right.
you could wear it in like 3 or 4 situations.
You could take your horse out like once a year out of the stable.
or
like
some of my
tops.
horses. Yeah. No, this is true.
Mike can wear his white T-shirt every week.
That's right, Duncan.
That's right. Mike has been doing this stealth wealth for a long time.
That's true.
Absent the wealth part. All right. All right. I was just curious on your thoughts. You're both dressed lovely today, though, of course. So, you wanted to talk about Djokovic and Jokic, and I did too.
Yeah.
Serbia is so hot right now. What do you think's going on? It's just a coincidence? Or are they producing really stellar athletes?
Well, it's two different things, right? In tennis, you've had a long history of international players being great, back to Rod Laver, right?
Yeah.
Lendl, the big three. Basketball, it's new. I mean, Jokic is effectively a descendant of Josh. I mean, he's got the dad bod.
Okay.
He's
I
got
like
the chin. I mean,
Yeah.
you could probably be a stunt double for him.
He's
in
7
basketball.
feet. He's 7 feet tall.
They can work on that with cameras.
Okay.
It's pretty amazing.
Yeah.
Like it's just.
But even with that body, he runs up and down the court and plays both sides of the ball.
he's amazing.
I just want to be fair. Like, this is like former Soviet bloc, like athletes. So like, I would.
These are Drago descendants.
Yeah, I would suggest there's always been a level of athleticism, maybe not 7-footers or anything, in that area of the world. And like Serbia, that whole area, those countries have changed names a million times.
Yeah,
like
yeah.
my family comes from that area, and like that.
One time in Los Angeles,
Slav
Josh
kind
and
of
I
thing.
sat next to Djokovic. Remember
Really?
that? He was behind
we were
us.
at Catch LA.
Yeah.
Not to brag. Stealth
But,
wealth,
like-
Michael.
No, that I wore my logos to that place.
you had one and you wore it? Okay.
But I would argue that part
Was
of
it
the
Nike?
world, that part of the world is Lithuanian. Like they have produced good athletes. It's just Serbia's day in the sun.
I
Here's
think in the NBA, the talent pool is now global.
Mm-hmm.
And
Oh, the best
Yeah,
players
absolutely.
are global.
best players are
And
not from the
Embiid,
United
Yep.
States.
Giannis, Luka, Jokic.
Remember, didn't they do the Rising Stars game? They used to, rest of world versus
Yeah.
US,
Yeah.
and
Yeah.
this year they stopped. That might have been a crime scene if they ran that.
Oh, and Wembanyama.
Yeah.
So
He's coming.
literally, like the best players in the world, except for Steph, are all international. This is a crazy stat. The 2023 NBA playoffs were the league's most watched in 5 years. Not quite sure why. I wonder what the finals ratings were. I loved it.
The finals ratings were down
Yeah, I'm not
6%. because the Nuggets were never on national TV the whole season.
It's also strange because so many of the playoff games were blowouts.
Yeah.
It was just a strange playoff
See,
setup.
I'm a Celtics fan, and this was like the most stressful, horrible playoff run
It's tough.
to watch.
I mean, you got far. It just sucked
but
who you lost to.
Really bad
Well,
ending.
not only that, but they managed to give you a heart attack through every series of whether or not they were going to make it through. Like they should have been crushing people, and they would let everybody hang. I felt like they
If they had gotten by Miami, how do you think they would have played
they would have
against Denver?
they would have lost. They
Yeah.
would have been the same outcome.
They would have got crushed.
Yeah, I agree.
Sweep or 5, yeah.
I think the finals were down. So number one, there was no Game 6. Number two, last year was Celtics, which is a legacy team,
Right.
Warriors.
and Warriors, which has the most popular player. And so it's obviously San Francisco Bay Area viewership is way bigger than Denver.
To Michael's point about the finals being down, but the rest of the being watched, you had the Celtics and Lakers in there.
And it wasn't a great
Yes.
playoffs. It
No.
really wasn't.
I thought some of the games were really fun.
There was not
weren't-
a ton of drama.
Actually, Miami was in
think-
all the best series.
I was going to say Miami actually kept it interesting.
So
the whole
Miami
time.
beat the shit out
Yeah.
of the Bucks, and then did they beat the Sixers? No, the
it was
Celtics.
the-
Sixers.
it was
They
the
beat
Knicks.
Yeah,
It
yeah.
the
was the
Knicks
Knicks.
series was a good series, though.
It was decent.
And then the Celtics Sixers was
Yeah.
a good series.
That went 7.
And then Celtics Heat
Went
was
7.
That was
Yeah.
a great series,
Yeah.
especially the Game 6
Yeah.
ending.
I want to end on this. Jack Dorsey has a $300 million bar bill, basically.
What?
That's there
How
was
many Clase Azules did he drink?
no. They're saying like he bought Tidal.
Thank you, John.
He bought Tidal, the music streamer,
Uh-huh.
just to make friends with Jay-Z, and he got sued for it. This is real. Many people assume that Twitter was the reason for Jack Dorsey's impressive fortune. That actually isn't the case. When Elon Musk acquired Twitter in October 22 for $44 billion, Dorsey only held 2%. So he got like $900 million out of that. The true source of his
Square.
wealth is in the friendships he made along the way. No, the true source of his wealth is Block, which he has 43 million shares.
It's Square.
Well, they call it Block now.
I don't.
That's worth $2.75 billion. So
I'm not going to cry because he only got $900 million.
he'll be fine. He'll be fine. On March 4th, the world was taken aback when Block announced its agreement to acquire Tidal for $306 million. The news broke through a tweet from Dorsey that showcased him hanging out in the Hamptons with Jay-Z. Fast forward, a lot of people weren't happy, etc. A lawsuit brought by Block shareholders said the idea for Block's acquisition of Tidal came while Dorsey was summering with Jay-Z in the Hamptons. It was an out-of-the-blue acquisition, and
That makes no sense. Why would they own that music
Yeah,
company?
I was going to say there's absolutely no like.
well,
it
the
doesn't
shareholders
make-
lost, so they sued and they lost. The recent legal battle ended in defeat for shareholders. The Delaware judge overseeing the case ruled against shareholders, emphasizing from a technical standpoint, doing a bad business deal doesn't violate any laws.
Not wrong.
And then somebody involved said basically this was a $300 million bar tab to hang out with Jay-Z. Your thoughts as somebody who's seen a lot of deals and read a lot about deals?
In the words of Charlie Munger, I have nothing to add.
Good.
There you go.
Shana,
I got nothing.
you wouldn't spend $300 million to buy something from Jay-Z just so
No.
you can hang out in the Hamptons with him for a summer?
That's not stealth wealth.
No.
That is we say that's the opposite of stealth wealth.
I would.
Maybe if I had $3 billion, I would.
Have you ever seen or heard of a Tidal listener in the wild?
No.
Never ever, right?
Never.
Okay. I'm convinced that there's really no audience there at all. So, all right, you guys have fun on the show today?
I did.
Sure.
Yes?
Yes.
Was it everything that you hoped it would be?
Yeah.
We absolutely loved having you.
Thanks for having us.
What's before we get into favorites, what's next for the Queen? What do you got going on?
We're doing some cool stuff at Bonrian.
Okay.
We
Tell
have
us.
an amazing tech partner that has built all our technology.
Is it Tidal?
No, it's called AlphaBot. And our Dimitri, who's the gentleman who runs AlphaBot, is helping us with an integration to do an end-to-end solution for advisors from like the front end to be able to also do all the streamline the operational compliance reporting and everything. And super excited about that because AlphaBot already was cool because it's one of the only analytical tools available to advisors that can do optimization with private fund vehicles and traditional investments, which is very rare. So this optimization is going to be a game changer. I'm super excited about.
When does that come out?
Well, I can't talk a ton about the details, but I'm hoping at the end of the summer we'll have something to announce.
Okay, congratulations. Looking forward to checking that out. And Ted, you have the book coming, and tell us what to expect on the podcast in the coming weeks.
Oh, more of the same. Coming weeks.
Who are the best guests you've had on? Not the best. I don't want you to do that. Who are like some of the more interesting guests that you've had on this year?
And Chris Sacco was just on.
Okay.
He's the one who owned all the Twitter that Dorsey didn't own.
I feel like I haven't seen him in the news lately, actually.
Yeah, it's the first time he's done it in a couple of years.
Yeah.
They've been heads down investing
Very
in
cool.
environmental stuff. Yeah.
Okay. Who else?
Boy, it's hard to ramble it off. It's been a good run.
Yeah.
I had Lasry on recently.
Oh yeah, Mark's always good.
Just a lot of great
When are you
guests.
going to have Shana on?
I don't know. We're going to figure that out.
I've already told Ted that I have a client that he needs to have on first.
Oh, look at you.
We're
Come
taking care of our
selfless.
clients first.
I
It's
got to take
impressive.
care of my
Yeah.
clients.
All right. Well done. All right. We're going to do favorites. We're going to ask you guys to share something with the audience that you think maybe they haven't checked out yet or might enjoy. Michael, let's start with you today.
Well, I can't do what you just said, but I just want to congratulate the Denver Nuggets fans. They have never won a championship. I had a lot of fun watching them beat the Heat as a Knicks fan, so I had a great time.
I like when a city that's never won wins it.
Yeah, it's awesome. It's great.
I'm
Very
cool
happy
with that.
for them.
I'm with you. Okay, Shana, what do you got for favorites?
So I was thinking about this. One of the things I saw that I was super excited about is on Amazon Prime, there is a documentary that just came out called All In, A Miracle at St. Bernard's. And the reason this is so cool to me is that St. Bernard's is in Fitchburg, Massachusetts. So that's around the area I'm from. My former high school, St. Peter Marian, is mentioned a lot in this series.
Okay.
What's it about?
So it's about a Catholic
It's about
school
Chamath.
in Fitchburg that was going to be shut down by the Diocese of Worcester. Worcester is my hometown. And that with 100 kids fielded a football team of 30 kids that won back-to-back state championships.
Oh, wow.
With 30 kids, 100 kids total in the whole school. And through the exposure that they got in the media, they were able to raise over $2 million and convince the diocese to allow them to privatize. And now their enrollment's up like 60%. They've raised over $3 million. And it's an amazing story
So
of
the
how
football
the
team
football
saved the school.
Yes.
Oh, that's cool.
It's a very cool story. And the funny part is when I was at St. Peter Marian, we used to absolutely beat the crap out of St. Bernard's.
Okay.
Like we had kids that, one of my friends, Jerry Azuma, went on to play for the Bears for 10 years.
Yeah.
And we had kids go on to the NFL from our team, and we were the ones that was crushing everybody. So the irony is not lost on me that St. Bernard's little football team with 30 players was able to save their school, and St. Peter Marian doesn't exist
Is it a
anymore.
movie or a documentary?
It's a documentary. It's
Okay.
super cool. It's on Amazon Prime. And
When did this happen? When did it take place?
2000, they got their ability to privatize January of 2020.
Oh, so this is recent.
Very recent.
Oh, very cool. Are you a Patriots or a Bears fan?
I'm a Patriots fan. Born
Okay.
and raised. My grandfather didn't have a lot, but the one thing he did love was sports. And so when the Patriots became a team, he got season tickets, in the 60s.
Yeah.
And so I lived through the burning my legs on the bleacher seats at the old, whatever, I can't even remember the name of the stadium when it was
Right.
just Foxborough, before Kraft, when we sucked
You had
so
Bledsoe
bad.
and
No,
who
we had
was before that?
Stan, Grogan.
Oh, yeah.
That's before my time. I
Yeah,
remember
we
that
had
guy.
Grogan, and we had those guys. I've met Steve Grogan. He's a good dude. But yeah, that's what I grew up with. So I'm a Patriots fan. I'm a Celtics fan. My dad very, very briefly played for the Bruins, for a hot second. And then he met a Rockette, and then he stopped going to practice and got cut. But it's a fun story, actually. So I'm a huge Bruins fan. The only team I have given up allegiance to is the Red Sox, but I moved to Chicago in 2016. And how could you
All about
not?
Theo.
How could you not
you got the
become
fever.
a Cubs fan?
Yeah,
after
I'm with
that?
you on that. I'm with you. You got the fever.
Yeah.
Ted, favorites.
All right, more sports.
Good.
The one less known, my friend Brent Montgomery, who created Pawn Stars, his most recent
really?
Netflix show is called The King of Collectibles. And it's
Oh, that's
all
Golden, right?
sports. Yeah, Ken Golden. Sports collectibles. They did a whole series. It's really cool.
Who is the king of collectibles? And
Ken
should
Golden.
we introduce him to the queen of alternatives?
It's
I haven't watched it
probably-
yet. It's good?
Yeah, it's good. It's really good.
Did you see the Arnold doc?
That just came
It
out.
was great.
I didn't watch it
not
yet.
yet.
It was great.
No.
I'm
And then
sorry,
the
go
other
ahead.
one, I mean, this is like, I guess you have to say it. So I've watched the season finale of Ted Lasso now 3 times. I don't think I've ever watched
new
a
season.
Netflix show. Well, maybe the last season, maybe not.
That's a little weird. Go on.
It is one of the best finales of any series
Why?
that I can remember. Every segment of it set up or wrapped up one of the storylines over force. It's just so good.
I watched season 2. I haven't started the new season. I have to watch the whole
Finale
season
of the
to watch
last
the
season,
finale.
unbelievable.
Okay. All right, we'll check that out. I wanted to what did I put in here? Oh, I don't really subscribe to a lot. I subscribe to Wall Street Journal, New York Times, almost because like I have to, and then a few Substacks that are friends of mine that I'm paying because I'm supporting them. I subscribe to Puck because I just think like they're doing the most interesting writing about just like power and who's like running shit and what's going on. And they cover 3 verticals. They cover Wall Street, Silicon Valley,
Hollywood?
and Hollywood. And I almost thought to myself like, and DC, excuse me, 4. And what else even matters? Like if
Nothing.
you're trying to figure out what makes the world go round,
Those are the 4 things.
Sports.
no,
No,
not really.
They have
no.
zero influence
Yeah.
on anything.
Well, that's true. It doesn't matter, but it matters. It matters.
It
to me.
matters.
No, but this is more about like they're writing about the people behind the big trends
Yeah.
that are affecting all of us. Like sports is a
No,
diversion.
I agree. So politics, sports, media.
It's DC specifically, not just politics like they're covering somebody running for
All right, so
something in
DC.
Kansas. Washington, D.C., Wall Street,
Hollywood.
Silicon Valley, Hollywood.
Yeah.
What else matters?
Named after a piece of hockey equipment.
Puck, right. I think it's probably named after the like the little cherub, maybe. What I don't even know what that thing is. Like the Puck building in Lower Manhattan, right? I don't know.
Yeah.
All right. Almost doesn't matter. Great writers, great reporter, like full-time reporters. It's not like somebody's hobby Substack. So anyway, I can't remember the last time I pulled out my credit card to subscribe to something, but Puck is pretty great. And for free, they have a podcast called The Powers That Be. So if you just want to dip, you could dip. The second thing is another podcast. I'm sure you listened to Acquired, right?
Yeah, sure.
Did you listen to the Dara episode
Not
about
yet.
Uber?
Yeah, not yet.
Incredible. That's like one of the best CEO interviews ever, and not because they're talking about Uber, which I'm a shareholder in, so I have like my own self-interest. The story about working for Barry Diller, getting the opportunity to save Uber, and then Barry supporting that, and it's just like stories that you don't really hear that often. So highly recommend the Acquired podcast, the episode about Uber. All right, that's all we have for today. Duncan, any announcements before we get out of here?
No, I think we're good.
We're good to go? Okay. I really appreciate it being 85 degrees in here today. So if
They did it for me. They did it for me.
Were you cold when you walked in? I bet you're not
was.
anymore.
Not
All right.
anymore.
Hey guys, thanks so much for listening. Make sure you subscribe. Very important. Make sure if you have not already, write a review. Duncan loves to read the reviews. He reads them to us. We appreciate hearing them so much. Also wanted to mention, if you are a visual learner like I am, this show appears on YouTube every day about 8, what would you say, John? 8 hours after the podcast drops ish?
Yep.
Yeah?
That's normally around.
All right. So you know where to find us, youtube.com/thecompoundrwm. Thanks so much for listening. Thanks to our guest, Ted Seides, and thanks to Shana. Guys, where could people follow you? You're a Twitter guy still, or?
Yeah, but
Ish.
it's mostly capitalallocators.com.
So follow
Just old
Capital
school,
Allocators.
Old school website.
I know I do. Shana, where do you want people to follow your stuff?
I'm on Twitter and Instagram. So Twitter, I don't have a fancy handle.
What is it?
Shana S621. And on
Killer.
Instagram, I go with my finance queen.
That's right.
I wear my crown.
That's right. You are the queen of all time on Insta. All right, guys. Thanks so much. We will see you next week.